This video is for AQA A-level economics, concentrating on mostly AS economics with monetary policy, and we're going to be looking at the transmission mechanism with in relation of the Bank of England or a central bank utilising or using interest rates in order to control the level of inflation within an economy. Now, this is quite topical at the moment because there's a lot of news about interest rates in terms of the Bank of England and as to whether they should increase interest rates or not. A lot of newspaper articles are suggesting that the Bank of England are considering doing so. One of the reasons might be is because at the moment the inflation rate is between 3 and 3.1%, which obviously exceeds the 2% target. So they are considering it. Now, what this video will look at is it'll look at how this will impact customers and businesses in terms of this interest rate increase, and again how it could be used to therefore then control the level of inflation within the economy. So this is the diagram of the transmissions mechanism in terms of how the official interest rate set can have an impact on the rest of the economy. Now, I'm not going to look at every single one of these in this video. I'll do a couple of videos based on this, but the one that I'm going to focus on is going to be this one here, okay, in terms of market interest rates. And I'll also tap in a little bit in terms of expectations and confidence. So if the Bank of England does decide to increase their interest rates and the MPC decide it's time to do so, then that'll change the repo rate that is set to the marketplace. And simply that is what the repo rate means, the rate that's set to the market in terms of, for example, the high street banks. So if the Bank of England increase the interest rates, then what you'll find is the market rate will most likely also increase. So in terms of the high street banks, and the lending and the ability to save of these high street banks will be impacted because of the change in interest. First of all, what you'll find is obviously credit will be more expensive. So if businesses or if customers are wanting to get credit cards, overdrafts, mortgages, bank loans, then they'll have a higher cost of borrowing. So again, if customers they were thinking of maybe purchasing a house, they might hold on to the idea because they may think it's too expensive at this moment in time to do so because of interest rates going up. If they're thinking of another type of purchase, like maybe a car or something along the lines of that, then again they may put off all those purchases because of the rate of interest. And remember, the whole reason you borrow is to spend. So because there's a higher cost of borrowing, the likelihood is there'll also be lower consumption. Now, if we consider savings accounts, if the interest rate goes up, then that means that the interest rate on savings accounts may also go up, and therefore it would encourage you to perhaps save. So it would discourage borrowing, but it may encourage saving. Now, if you're saving, then what you find is the MPW, the marginal propensity to withdraw, increases because you are saving now. And if you're saving, then you're not spending. So as I've put there, the high cost of borrowing, greater reward for saving, higher chance of a marginal propensity to withdraw, and therefore there'll be a decrease in the marginal propensity to consume. So because there's a greater withdrawal from the circle of flow and because there's less consumption, obviously consumption is a component of aggregate demand. So what you'd find is aggregate demand would be reduced, it would fall. And if you're looking at how to draw that in a diagram, because of the whole concept and the whole reason why they're setting the increase in the interest and increase rate, I would probably draw a Keynesian diagram using long-run aggregate supply. And what I would do is I'd have my AD1 as close to the productive capacity, showing the pressure on the price level, and then I'll have the AD falling, reducing that pressure on obviously the price level. Because we don't know the multiplier effect, we don't know how detrimental it might be. If I was drawing an exam, I'd probably not draw the AD2 curve too extreme. I'd just show it to where the Bank of England have calculated that it should only just relieve pressure and not cause too many problems to the economy. We can also look at it from a business point of view, and we can look at it in terms of how it might impact businesses. If you think about it from the point of view of businesses, then again, why do they borrow? They borrow to invest. They borrow to expand operations. If they know that there's going to be a higher cost of borrowing, then they're going to put their investment possibly on hold. There might even be a lack of confidence because they're starting to recognise that actually maybe demand is starting to fall, and there is less consumption because of the increase in interest rates and because there's that high reward for saving maybe. So businesses might be very reluctant to actually invest, and again, as investment is obviously an injection into the circular flow, and it's also a component of AD. If businesses reduce that investment that they were previously making, then again it might reduce AD. So you can look at it from that point of view.